This video is created to provide an opportunity for students to understand double entry concept through looking to questions with solutions of daily or infrequent accounting transactions. In addition, how these transactions affect accounting equation. Assets equals liabilities minus stockholders' equity. Income statement and balance sheet. 1. Company A sells goods to a customer for $20,000. The cost of goods is $11,000. Prepare sales revenues entry. Account receivable of $20,000 should be debited, and the revenues credited for $20,000. Assets increase by $20,000, and stockholders' equity is increased by the $20,000. In this transaction, revenues is increased in the income statement, and account receivable is increased in the balance sheet. Two. Company A sells goods to a customer for $20,000. The cost of goods is $11,000. Prepare the accounting entry. The appropriate entry would be a debit to cost of goods sold for $11,000, with a corresponding credit to inventory for $11,000. Assets decrease by $11,000, and stockholders' equity is decreased by the $11,000. In this transaction, cost of goods sold is increased in the income statement, and inventory is decreased in the balance sheet. Three. Record salaries and wages of $6,000 earned by employees but not paid. Under this question, salaries and wages expense is debited for $6,000, and salaries and wages payable is credited with same amount. Liabilities increase by $6,000, and stockholders' equity is decreased by the $6,000. In this transaction, salaries and wages expense is increased in the income statement, and salaries and wages payable is increased in the balance sheet. 4. Company A purchased long-term asset at a payment of $20,000. Estimated life of the asset is 10 years. Record the accounting transaction for depreciation expense. Debit depreciation expense for $2,000, and credit accumulated depreciation for $2,000. Assets decrease by $2,000, and stockholders' equity is decreased by the $2,000. In this transaction, depreciation expense is increased in the income statement, and accumulated depreciation is increased in the balance sheet. 5. Company A owns equipment that cost $20,000. Depreciation has been recorded at $3,000 per year. The equipment has total accumulated depreciation of $12,000. The equipment is sold for $14,000. Debit $12,000 and $14,000 to accumulated depreciation and cash respectively, and credit $20,000 to the equipment. This leads to additional credit to gain on sale of equipment for $6,000. Assets increase by $6,000, and stockholders' equity is increased by the $6,000. In this transaction, gain on sale of equipment is increased in the income statement, and the equipment with accumulated depreciation are decreased in the balance sheet. Lastly, cash is increased in the balance sheet. 6. Company A owns equipment that cost $20,000. Depreciation has been recorded at $3,000 per year. The equipment has total accumulated depreciation of $12,000. The equipment is sold for $6,000. The accountant would credit $20,000 to equipment and debit $12,000 to accumulated depreciation, $6,000 to cash and $2,000 to loss on sale of equipment. Assets decrease by $2,000, and stockholders' equity is decreased by the $2,000. In this transaction, loss on sale of equipment is increased in the income statement, and equipment with accumulated depreciation are decreased in the balance sheet. Finally, cash is increased in the balance sheet. Company A reports revenues of $20,000. It estimates bad debts at 10% of revenues. An accounting transaction is made to debit bad debts expense for $2,000, and credit allowance for doubtful account for $2,000. Assets decrease by $2,000, and stockholders' equity is decreased by the $2,000. In this transaction, bad debts expense is increased in the income statement, and allowance for doubtful account is increased in the balance sheet. Company A purchased 100 units of inventory at $100 term N30. The entry can be done by a debit to inventory for $10,000, and a credit to accounts payable for $10,000. Assets increase by $10,000 and liabilities are increased by the $10,000. In this transaction, inventory and account payable are increased in the balance sheet. (9) Company A purchases a patent from Company B for $3,000. The transaction is completed by debiting $3,000 to patent, and crediting $3,000 to cash. In accounting equation, this transaction has no effect on assets. In this transaction, the patent is increased in the balance sheet. On the other hand, cash is decreased in the balance sheet. 10. Company A purchases a patent from Company B for $3,000, and a useful life of patent is 6 years. Record the accounting entry for an amortization expense. Debiting amortization expense for $500, and crediting patent for $500 to record annual amortization of patent. Assets decrease by $500, and stockholders' equity is decreased by the $500. In this transaction, amortization expense is increased in the income statement, and patent is decreased in the balance sheet. 11. Company A receive $5,000 cash payment in advance before goods delivery to the customer. Record the accounting transaction for liability. The liability is recorded by debiting cash, and crediting unearned revenue for $5,000. Assets increase by $5,000, and liabilities are increased by the $5,000. In this transaction, cash and unearned revenues are increased in the balance sheet. Company A has to reduce $5,000 of unearned revenue account because goods have been delivered to the customer. Unearned revenue of $5,000 should be debited, and the revenues credited for $5,000. Liabilities decrease by $5,000, and stockholders' equity is increased by the $5,000. In this transaction, revenues are increased in the income statement, and unearned revenues are decreased in the balance sheet. Company A paid salaries and wages to their employees for $6,000. Company A should credit cash for $6,000, and debit salaries and wages payable for same amount. Assets decrease by $6,000, and liabilities are decreased by the $6,000. In this transaction, salaries and wages payable and cash are decreased in the balance sheet. Prepare the accounting transaction entry to record the income tax expense of $200. The accounting journal entry would be a debit to income tax expense for $200, with a corresponding credit to income tax payable for $200. Liabilities increase by $200, and stockholders' equity is decreased by the $200. In this transaction, income tax expense is increased in the income statement, and income tax payable is increased in the balance sheet. Company A board declared a $1,000 dividend cash payment to be paid to stockholders on December. Retained earnings is debited for $1,000 and dividend payable is credited for $1,000. Liabilities increase by $1,000, and stockholders' equity is decreased by the $1,000. In this transaction, dividend payable is increased in the balance sheet. On the other hand, stockholders' equity is decreased in the balance sheet. On December, it is time to record cash payment of $1,000 to stockholders. Enter the accounting transaction. Debit $1,000 of dividend payable and credit $1,000 of cash. Assets decrease by $1,000, and liabilities are decreased by the $1,000. In this transaction, cash and dividend payable are decreased in the balance sheet. Company A made a deal to sell shares to investors. It initially issued 1,000 common stock shares of $20 par value for $100,000. Record the accounting transaction. Debit cash for $100,000 and credit common stock for $20,000 and paid in capital in excess of par, common stock for $80,000. Assets increase by $100,000 and stockholders' equity is increased by the $100,000. In this transaction, cash, common stock and paid in capital in excess of par are increased in the balance sheet. Company A purchased equipment for $10,000, term N30. The accountant would debit $10,000 to equipment and credit $10,000 to account payable. Assets increase by $10,000 and liabilities is increased by the $10,000. In this transaction, equipment and account payable are increased in the balance sheet.